Now we discussed in the depreciation concept that to compute the WDV or to compute the depreciation, we will take opening WDV, add purchases, minus sales, then we'll get the closing WDV. On that we'll calculate the depreciation. Correct? To get the opening WDV for next year. We discussed. But when we write add purchases, what should we write? If we have to write add purchases, we have to write the actual cost of purchase. So what is actual cost? It has a great meaning and analysis to do, which we'll do in this lecture. So section 43 subsection 1 talks about actual cost. So actual cost is the purchase price of the asset. Along with purchase price, now asset should be brought from the place to the factory, correct? So to the factory or to the office, the asset should be brought, correct? For that, whatever traveling expenditure is incurred, that is also actual cost. Not only that, but from after bringing, the machinery has to be installed, right? Some fitting has to be done. So installation, loading, unloading, all that expenditures will be there. That also forms part of the cost of the asset. And other than that, sometimes at the place itself where the plant is installed, we work on to increase the capacity of the asset. So if any expenditure is incurred to increase the capacity of that asset, that expenditure also forms part of the cost of the asset. So what we discussed, actual cost of the asset is the purchase price plus the traveling expenditure plus the loading unloading expenditure plus finally we have to understand the increased capacity expenditure. That all becomes the actual cost of the asset. Now there are some special points to be noted, right? That we'll discuss. Of course, yeah, when you compute the actual cost, trade discount is there that you have to deduct, right? So many things are there. We'll discuss. First point, that law says that any purchases happen, it should happen through account payee check. So suppose the purchase happens in cash or through something called as, I can say, through cash or through bearer check, then the payment in bearer check or in cash is not counted. That means the payment made for the asset through account payee check or DD or through banking channel, right? Banking channel means I am saying NEFT, RTGS, UPI, that I am talking about. That cost only is counted, but cash payment, check payment through bearer check, right? Crossed check which is not account payee, that also will not be counted. Okay. So when actually in a problem, it is given that 5 lakhs is the payment made, out of that 1 lakh is cash, then you will take 4 lakhs only as the cost because that payment is done through account pay. Like this you should be able to interpret, okay, while solving the problems. Now come to the second point. Suppose example, we got some gift, right, or through will we got some asset. So what should be the value of the asset? So whenever we get a will, what happens? Whenever we get a gift, what happens? The asset is already used for so many years. So whatever the cost to the previous owner minus depreciation for so many years, whatever the final WDV comes, that is the WDV of that is the cost of the asset for us. Okay, you should be able to understand this way. So basically whenever we get a gift or whenever we get something called as a will and through that we get the asset, then suppose the previous owner kept it for 5 years. So whatever is the cost to that previous owner minus that 5 years depreciation, whatever WDV comes, that is the cost to us. Okay. Now, suppose to purchase the asset, we took some loan and now we are paying interest on the loan. So interest up to the date of putting the asset to use should be added to the cost of the asset. Interest up to the date of putting the asset to use should be added to the cost of the asset. And after the asset is put to use, right? After the asset is put to use, right? If any interest is there, that should be treated as revenue expenditure. So, any interest paid on the loan taken to purchase the asset should be divided based on period up to the date of putting the use and after the date of putting to the asset to use. If it is up to the date of putting the asset to use, we have to add to the cost of the asset. Okay. And interest after the date of putting the asset to use should be treated as revenue expenditure. Okay. Suppose subsidy we got for purchasing the asset. Then the subsidy should be deducted from the cost of the asset. Subsidy is a discount, okay, or whatever payment I have to do, some government organization paid. So it is not cost to me, correct? So that's why whatever the purchase price minus subsidy should be deducted, right, to get the cost for depreciation purpose. Okay. Now, if suppose there is a senvatable concept, today, of course, excise duty is not there in many cases, but still, some cases it is relevant. So we are discussing. Okay. If there is a senvatable credit, so on purchase of any plant and machinery, some senvat credit is available. Now, that credit we can use for further payment. In that case, that senvat credit should be deducted from the cost of the asset. Or I talk in present context. Suppose we purchased a plant and machinery on which GST also we paid. Now suppose if you can claim input tax credit on the asset, then what to do? There is a law which is clearly saying, so let me tell you current law. Okay. Earlier, if you can claim credit, that is reduced from the cost. Okay. But here what happens is, they are clearly telling that suppose if you want to claim input tax credit for the asset, if you want to claim input tax credit for the asset, then the GST element should be deducted from the cost, and I can say you cannot claim depreciation on the asset, right? So either you basically claim input tax credit under GST or you claim depreciation under income tax, but you cannot do both. I'll claim input tax credit also and I'll claim depreciation income tax also. Who will check? Don't feel like this, because data is shared. And once you get the notice, you have to not only pay the extra tax, but also pay penalty, interest, and lot of other complications. Okay. So in GST regime, what you supposed to remember? Either claim input tax credit on the GST paid on the asset in the GST law, or ignore input tax rate in GST and claim depreciation under income tax, right? But don't try to get the both. It's not allowed. Now, if it is not under GST, if it is under excise duty, then obviously you can deduct the senvatable credit from the cost. That's simple, which we discussed here. Now, let's continue with the next point. Suppose example, you transferred the asset to avoid the tax. Transferred the asset to avoid the tax. Then what to do? The assessing officer, once he comes to notice that you are trying to avoid the tax, he will take the approval of deputy commissioner and will revalue the asset and tell you that only this is the value we consider, and on this value only you can claim depreciation. So whatever you showed that cost is not considered, whatever assessing officer says that cost should be considered. Okay, clear? Next, suppose example, you transferred the asset and then you reacquired it. You transferred, that means sold, then you only repurchased. Then what should be the cost for you? So at the time of transfer, what was your WDV? Okay, suppose I transferred the asset to some entity. Then what was the WDV at the time when I transferred to them? And later on I purchased, correct? So what is the purchase price? Out of the two, whatever is lower will be treated as cost. Okay, out of the two, whichever is lower will be treated as cost. Now come to the next point. If suppose I sold the asset and again took it on lease basis. I sold the asset and I took it on lease basis. What should be the cost to the lessor? Lessor means not me. Now I am lessee. Okay. I took it on lease means I am lessee. So for lessor, what is the cost? So WDV to the transferor. So whatever is the WDV to transferor, that becomes the cost. This way you should be able to understand. Now I'll tell you next point. That is about building. Suppose example, building was used first for personal purpose. Later on what happened? The building is used for business purpose. Now what should be the cost of the building for the purpose of business? So the income tax department says that how many years the asset was used for personal, that building is used for personal. If you say 5 years, then okay, what is the cost? Okay, take the cost. Minus deduct depreciation for 5 years. Right? Whatever current rates of depreciation for commercial building are there, because we are going to use it for business, correct? So for commercial building, how much is the rate? 10% today. So that rate for 5 years will deduct. And whatever WDV comes later on, that will become the cost to the assessee. Okay, this point you should be able to understand. Now when I said building was used for personal, later on used for business, then what I said, you take the actual cost, deduct depreciation for so many years of use, then whatever WDV comes, that's the cost. Same is the case in case of a foreign asset brought to India. So asset used in foreign country, later on brought to India. Same, how many years it was used? From actual cost, deduct the depreciation for that many years. And whatever WDV comes, that becomes the cost. Okay. Now, for building, I said when it was used for personal, later on converted to business, then I said take actual cost minus depreciation for so many years. But is there any such rule for other assets? Like if it is a motor car, if it is a laptop, is there any rule as such? The answer is no. So when they talk about any other asset which is used for personal purpose then brought into business, don't deduct the depreciation. Take actual cost as it is. Okay. So for building from personal to business, actual cost minus depreciation for so many years, balance WDV is your cost. But for all other assets, first used for personal, then brought into business, take direct actual cost. This way you should be able to understand the topic. Okay. Now, when it comes to holding company, transferring asset to subsidiary. Now, when holding company transfer the assets to subsidiary, what should be the cost to subsidiary? Are very easy answer. Whatever WDV to holding, that becomes the cost to subsidiary. Suppose example, subsidiary is transferring the asset to holding. Now, who is the transferor? Subsidiary. To whom? Holding. Then, what is the WDV? Whatever the WDV of subsidiary, that becomes the WDV to holding. So now let me tell you one thing. I am going to talk about holding subsidiary now, then amalgamation case now, demerger resulting company case now. In all these three cases, it is very simple that take the WDV to the transferor. What you will take? WDV to the transferor becomes the cost to the transferee. What I said, WDV to the transferor becomes the cost to the transfer. Okay. So what I said, I spoke about holding company transferring to subsidiary, subsidiary transferring to holding company, amalgamated company transferring its asset to amalgamating company, transferring the assets to amalgamated company, right? A demerged company transferring assets to resulting company. In all these cases, what you are supposed to remember, tell me? WDV to transferor becomes the WDV to the transferee. Now, next point is corporatization of the stock exchange. So earlier in the past times, stock exchange was just an association of traders who wanted to buy shares, sell shares. Now that association of stock traders was actually converted into a company, or I can say corporate form. In that case, what happens? Whatever association assets are there, assets belonging to that association were transferred to that company. Now tell me, what should be the WDV? Obviously, WDV to that association becomes WDV to the company. Okay. And all the members in that association got the shares in the stock exchange. Okay. This way it was done to give a more formal structure to stock exchange. This was done in past. Okay. Let's come to the next point. Suppose somebody is there, he did not file income tax returns because he was not required to file. Let's think that he was earning such income which is not at all taxable. He not even required to file returns. So he did not file. He had lot of plant and machinery. He used it, right? He prepared P&L account. He prepared balance sheet. Everything is fine. But no income tax required. So no returns filed. But now his business become a taxable business. His income from business became taxable. So what is required? Now he has to actually compute the depreciation on the assets which he has for so many years from the date when he purchased till today, right? Till the first day of the previous year when the business became taxable. So he'll take actual cost minus depreciation for so many years. The balance becomes the WDV, that is actual cost to his business as per income tax. Okay. Now some assets are there which are mentioned under 35AD, like cold chain facility, affordable cold chain facility, like inland container depot, cross country pipelines for petroleum, natural gas, right? So these type of things are there. So these are mentioned under section 35AD. Now there 100% deduction is claimed there itself. So now if 100% deduction you get under 35AD itself, then is there any need to claim depreciation? No need. So that's why actual cost for the assets mentioned under 35AD becomes zero, nil, right? If suppose the same assets are given as gift to somebody, to that transferee also, the cost will be nil. Obviously, if suppose there is a transferor, there is a transferee, there is a concept of gift, in that case, cost to the previous owner becomes the cost to the transferee, correct? So cost to the previous owner is nil here. cost to the previous owner is nil. So obviously cost to transferee also becomes nil. Okay, this way you should be able to understand. Now come to the next part. Suppose a inventory is there. When I was teaching section 28, I said conversion of inventory into capital asset. I said or not? What is the income I said? Because when inventory is sold in the market, the sale revenue would be generated, correct? So whatever that price is, that fair market value is, that becomes the income which is taxable under PGBP, and that becomes the cost of the capital asset in income tax records also. And when it becomes cost of the capital asset, obviously on that depreciation can be claimed. Okay, suppose I gave the example of a furniture shop. I said furniture shop is there. So in case of furniture shop, what did you realize? That furniture is stock in trade for them. So some furnitures, they kept it for office use now from the stock. So the fair market value of the furniture, which is used for office now, becomes business income, taxed as business income, and the same fair market value becomes the cost of the capital asset, and on the same value you can claim depreciation under section 32. This way you should be able to understand the topics. Okay, so we understood actual cost. So many concepts I tried to touch. Let me recap for all of you. Super fast we will recap. Okay, let me tell you. Hey, whenever we purchase an asset, take the purchase price, that is the cost. Traveling charges, installation, loading, unloading, all are included. Okay, if increasing capacity is there, such cost also we should definitely include. And then I'll tell you, if there is any trade discount, deduct it, no problem, right? If input tax is not claimed under GST, then definitely GST will become the cost of the asset and you can claim depreciation on it too. Okay, these are the things which we have to understand. Now, after that, I'll tell you, if any cash payment is there above 10,000 rupees, which I forgot to tell, correct? So, above 10,000 rupees, any payment in cash, complete cash payment is ignored. If you pay 5,000, 7,000, up to 10,000, still no problem. But more than 10,000, if you pay in cash, that is not considered as cost of the asset. So, how the payment should be? Through account payee check, through demand draft, correct? Yes or no? Through banking channel, NEFT, RTGS, IMPS, it's okay. Then I said that when we talk about, we get asset as gift. So cost to the previous year, previous owner minus depreciation for so many years. Interest on loan we paid to purchase the asset. Up to the date of putting the asset to use, add to the cost. And after the date of putting the asset to use, treat it as revenue expenditure. Subsidy, deduct it from the cost. Then we discussed NVAT credit, deduct it from the cost. If any assessee is transferring property to avoid tax, come on, assessing officer can actually determine the cost of the asset, right, with the approval of deputy commissioner. If any assessee is transferring the asset and reacquiring it, then WDV to the transferor or the purchase price paid, whichever is lower becomes the cost, right? Then we discussed that if there is a transfer, sale, and then lease back, you took it again as lease, then definitely WDV to with transferor becomes the cost. Then we also discussed that if suppose a building is there, building used for personal, then transferred to business, we discussed what to do. Building, whatever number of years it was used for personal purpose, deduct the depreciation from actual cost for that many years, and the balance becomes the WDV for the purpose of business, or cost for the purpose of business. Then if it is not building but other assets, then don't deduct any depreciation. Whatever actual cost is there, directly take as it is. Okay, right? And then start computing your depreciation from current year onwards. Building, from past years when the previous owner used or we use it for personal purpose, that many years depreciation will deduct. Whatever WDV comes, that becomes the cost we said. But for other assets, you use it for 5 years, 10 years, doesn't matter. Take actual cost and start claiming depreciation from now. That's what we discussed. Then in case of foreign asset brought to India, it was used in foreign country for some years and then brought to India. Treat as it is building and claim depreciation for that period, and then whatever WDV comes, that becomes the cost. For holding company amalgamation demerger case, we discussed that whatever, oh, three cases, whatever cost to the transferor, even in case of corporatization of stock exchange, whatever cost to the transferor, sorry, WDV of the transferor, that becomes the cost to the transferee. If suppose somebody did not file income tax returns in the past because he was not required to, then if he started filing returns from now because his income became taxable, then he will have to take the cost of purchase of the assets minus claim depreciation for that many years when he used it, and the WDV comes, that becomes the cost for the purpose of income tax. Then section 35 AD assets are there, cost is nil, and inventory converted to capital asset. Furniture example we gave, fair market value becomes the cost on which you can claim depreciation. Right? So quick recap we try to do. Now let's continue with conversion. Oh, sorry. If there is a foreign exchange, so you have purchased the asset from a foreign country, right? By taking a loan. So you purchased the asset from a foreign country by taking a loan. Now, when it comes to a foreign country, the rule is obviously you will transact in dollars or pounds, right? You may also transact in something called as ruble, correct? Russia's currency. So you can transact in multiple currencies. At the time of purchase, whatever the currency exchange rate was there, you multiplied and wrote the cost of the assets in your records in Indian rupee, correct? Suppose today you purchased $1 lakh worth asset, 82 is the current exchange rate. When you multiply, you will write cost to be 82 lakhs. $1 lakh into 82 rupees. So 82 lakhs will be the cost, correct? That's it. Now let's go to the next concept. If suppose you are paying interest on a regular basis, no problem, it is revenue, correct? But suppose due to currency exchange, next year when you try to repay the loan, the rate became 85. So $1 is equal to 85. So how much extra you paid? 3 rupees extra you paid. You repaid entire loan. So that extra 3 rupees whatever you paid into $1 lakh, that is 3 lakhs rupees, will be added in the next year. So whatever loss due to currency exchange will be added to the cost, but sometimes gain may also be there, correct? That gain will be deducted from the cost. So loss will be added to the cost and foreign exchange gain should be deducted from the cost of the asset. Okay, for the purpose of computing depreciation. Now, the gain or loss will happen in second year, third year, 10th year, later on, correct? So whenever you repay the loan in that year, you do that adjustment, no problem. Can you increase the cost later on? The answer is yes, you can. You can increase the cost if you have to pay additional bucks. If you paid less, then deduct, right? This is how the foreign exchange concept is. Shall we go to next point, that is unabsorbed depreciation. Are you ready for the same? Yeah. It's not that difficult, but not so easy also. Many students feel it is difficult. Let me tell you in a very simple manner. Hey, you prepare P&L account in accounts. You all remember, yes or no? Income tax is slightly different, I said. Okay. So you have credit side all incomes, debit side all expenditures. Okay. Incomes minus expenditure, you will get net profit. Correct. Same way in income tax, incomes under section 2841 minus expenditures under section 30 to 37, you get business income. Correct. But what they tell, that first thing, you deduct all expenditures except depreciation. Okay, take all incomes, 28 section, 48 section incomes you take, no problem. Minus deductions you deduct, section 30, 31, 33, 35, 36, 37 you deduct, no problem. But don't deduct depreciation. Okay, now you got business income before depreciation. Okay, suppose business income before depreciation is 1 lakh rupees. Now, when you deduct depreciation now, your depreciation is 1,50,000. Now tell me, your business income is 1 lakh, your depreciation is 1,50,000. What will you tell in accounts? In accounts, you will tell there is a net loss of 50,000. Correct? Obviously, 1 lakh is your income before depreciation and your depreciation is 1,50,000. So in accounting, you will tell 1,50,000 is your depreciation. In accounting, you will tell 50,000 loss. But in income tax, we don't tell like this. In income tax, we will say that there is no business income, there is no loss. But there is unabsorbed depreciation of rupees 50,000. Okay. So if any depreciation cannot be set off from the income, that becomes unabsorbed depreciation. Now what will we do with this unabsorbed depreciation? We can deduct this unabsorbed depreciation from any head of income, or we can deduct in the next year for no limit, unlimited number of years. You can deduct the unabsorbed depreciation till you exhaust it. Clear to all of you? Till you exhaust, you can deduct unabsorbed depreciation. Clear to all of you? Very good. So now your business income was 1 lakh. If suppose depreciation would have been 80,000, you would have said 1 lakh minus 80, 20,000 business income. But suppose depreciation is 1,50,000, then business income is 0, business loss is 0, but 50,000 unabsorbed depreciation. You can adjust it from any head, but can you adjust it from salary, casual incomes? The answer is no. So unabsorbed depreciation cannot be adjusted from salary income, and second one, salary income and casual incomes. From salary income and from casual income, you cannot deduct unabsorbed depreciation. From any other income, you deduct, no problem. Okay, either in the current year or in the future years. In future years, when I use the word, how many future years? There is no limit as such. Okay, very good. Now in future years, when I deduct, how should I deduct? So I'll first write the business income, or I can say I get the income, that is business income before depreciation, right? From that, I'll first deduct current year depreciation. Then brought forward loss, because brought forward loss has a limited period offer. That means that loss can be adjusted only for 8 years. So that's why first current year depreciation you deduct. After that, if you have brought forward loss, that you deduct. And still if you have income, no problem. Deduct unabsorbed depreciation to the extent possible. Unabsorbed depreciation will stay, no problem. Unlimited years you can claim that deduction if it is not exhausted. Correct? So this way you should be able to understand the topic. of unabsorbed depreciation. So what is unabsorbed depreciation? It is basically profit before depreciation. I'm talking about meaning. Profit before depreciation minus depreciation. When we do, if depreciation is more, how much extra depreciation is, that is actually your unabsorbed depreciation. You can deduct it in the current year from any head and in future years from business head or any head for without any limitation of period, but cannot be deducted from salary and casual income. But for deduction there is a process. So any year you want to deduct, please first deduct current depreciation, then brought forward loss from business loss, and last unabsorbed depreciation you deduct. Okay, because there is time you can adjust. This way you should understand the topic of unabsorbed depreciation. Okay, clear to all of you? There should be no doubt in your mind. Good. Now shall we go to the next topic? If you do this much also, it's more than enough. Okay, I can talk about section 72, 73 on the screen you see. But if I talk, you will do something wrong in the problems. Your clarity will miss out. Practically doing the things is useful, so I explained to the extent it is required. Okay, let me take you to the next journey. Now, is depreciation a mandatory deduction? The answer is absolutely yes. So depreciation is compulsory, you have to deduct it. No, this year I don't want to claim, I'll claim it in the next year. The answer is no, it's not permitted. Every year depreciation should be calculated. Okay, right. Last thing is case of amalgamation. Suppose amalgamation happens, two companies become one, or one company is transferred to another company. Right, one company is amalgamated into another. Suppose father transferred the business to son, succession we can say. Right, suppose a partnership firm is there that is converted to a company. In all these cases, how depreciation should be computed? That's what the question. In all these cases, if there is a succession, father transferred the business to son, amalgamation happened, the earlier company transferred the assets to the new company. How to calculate, what to do? The answer is simple. Believe that nothing happened. First thing what you should believe, that nothing happened, and then calculate the depreciation. So first believe that nothing happened and then calculate the depreciation for the whole year. Now you have depreciation for the whole year, correct? Divide this depreciation based on the number of days the assessee held. Let's assume partnership converted to company. So now, suppose example, partnership is converted to company on 1st July 2024. Now what I will say? April month, May month, June month. So April 30, May 31, June 30. So 91 days it was partnership. And balance 365 days minus 91, 365 minus 91 will be for company. So when you calculate the depreciation amount into 91 by 365, when I do for partnership, okay, depreciation amount into number of days the asset was held by company divided by 365. Like that actually we have to divide. So in case of amalgamation, right, one company transferring the assets to another. In case of succession, father transferring to son. In case of partnership converting to company, or any similar case, never worry. Simply first, how to calculate depreciation? There are two entities now. If it is one entity, then I'll do. Now it is two. I am in tension, sir. Nothing to worry. Treat as if it is one entity. first calculate depreciation properly. And after calculating depreciation for the whole year, then step 2, you have to calculate how many days each assessee was holding the asset. Accordingly, you divide the depreciation into parts and give the depreciation to the respective assessee so that they can claim it when they file their income tax return. Suppose an asset is purchased during the year. Then from the date of purchase till next 31st March, right? How many days are there? From the date of purchase till the date of transfer, how many days were there? You calculate, right? This way you can do. Suppose example, on June 1st, the asset was purchased by the partnership firm. So June has 30 days. So for partnership, it will be 30 days. And for company, balance days. Like that you have to calculate. Okay. This way, if you compute, you will be able to solve the problem whenever it comes. Suppose example, the asset is purchased by the company only. Okay, new entity purchased. Then entire depreciation will go to new entity. What's the problem? So this way, when you solve the problems, you'll have no doubt, you'll confidently face the questions also if they come in the exam. Right? So with this, we'll put an end to this video. We discussed so many concepts in this video. Some more problems will complete on depreciation. Okay? Chalo. Bye bye and we'll meet in the next video for solving the problems.